My name is Michael Guyad, publisher of the Lead Lag Report, our special guest, John Bollinger. So, John, I appreciate spend roughly an hour here with us, with the audience. I'm actually thrilled to be talking to you because I have a real affinity for people who have been trading and investing for a long time and also have, taken the step of actually creating indicators. I had Tom McClellan on talking about his family history, the McClellan oscillator. So this will be kind of a continuation, a little bit of that sort of direction. But before we get too deep into markets and Bollinger Bands, how to use them in this kind of environment, talk through your background. How did you get involved in markets? How did you come up with Bollinger Bands to begin with?
Well, I got involved in markets via my grandfather when I was a small tyke. He gave me some shares in a company called Fruhoff, which was the technology play of its day. This was in the beginning of a containerization, and they were the people who made truck bodies in containers. So you can imagine it was a beloved and storied stock, the way many beloved and storied stocks are in play today. And over the next years, I watched it go to zero. So that was sort of a baptism of fire in the markets. It got me interested in the markets, and I've been interested ever since.
Okay, so presumably something in your work over time made you realize that stock price gyration speeds change. What I'm talking about is volatility, obviously. And you thought that was something that was maybe exploitable from either a trend following perspective or mean reversion perspective. Talk through what was your kind of aha moment in developing the indicator.
So, I started back in the days when we kept charts by hand or updated chart books that were received by the mail, but mostly we kept charts and indicators by hand. And we used trading systems, much as we use trading systems today. A very popular one, and one that worked really well, was a trading system that used trading bands, 21-day trading bands that were spread up and down from the average by a fixed percent, usually something between 4 and 15%, depending on the stock. And, it was a problem because you always had to decide how wide the bands would be. And, if you were bullish, you set the bands to present a bullish picture. And if you were bearish, you set the bands to present a bearish picture. So you were letting emotions into the process. And I was looking for a method to have the bandwidths set by the market. At the time, I was an option trader. This was circa 1980. And it's really interesting because at the time, we believed that volatility was a property, like a house is white or a person is tall. We thought that, a stock's volatility was simply a stock's volatility and that it didn't change over time. If anything, the only way it changed was maybe over the life cycle of a company. As a company matured, its volatility would go down, starting with a startup, which would have relatively high volatility, to a mature company, like a mature industrial company, which would have relatively low volatility. And we used beta to measure that volatility. And he give you an idea how committed we were. You really only measured beta once a year, and you used 5 years worth of weekly data when you did so. We just didn't think that it was necessary to do any faster. Of course, the change was in the air. Robert Engel was doing his pioneering work on the volatility of inflation data, which would later earn him a Nobel Prize. So being an option trader, I was lucky. I had I had an early computer with a spreadsheet on it. This was back in the days when they were called microcomputers, before PCs. And one day I copied the formula for volatility down a column, and I saw that it was changing over time. And I started to explore that. And I realized that it might be just the mechanism I was looking for to set the width of trading bands. And that turned out to be entirely correct.
Let's talk about charting by hand for a moment. And I know that's kind of a strange lead in, but like my father had worked with Bob Farrell in the late 80s, right? And I remember as a kid.
Excellent.
Yeah, no, and he were alongside also a gentleman named Steve Shobin, who was fairly well known in the 90s. So he was
know
on
him
Farrell's.
too.
Yeah, no, we'll talk about that at some point. So I remember as I was a kid, right, watching my father literally draw on chart books and lay out and do the point and figure type of type of charting by hand. And he was one of those guys that was a historian. He has all these olds, and I still have them, these old tomes basically written by these kind of legendary technicians of the 20s, 30s, and 40s that you don't see published in libraries. Anyway, I remember very vividly my father saying that you don't really get a feel for a chart unless you actually do it by hand. I'm curious if you think that with the availability of charting software, with the ability of pulling up a chart from any website you can imagine, if you think that actually is not a good way of self-learning versus literally doing it by hand, if there's some power to doing it manually like that.
So, it's a double-edged sword that the technology allows us to do much more than we could do before. We can cover many more stocks, we can cover sectors, we can do a lot of things that we couldn't do before. But you lose a certain intimacy with the data and with the process. There's no question about that. Yeah, I guess the bottom line is, when I build something new, when I build a new system or a new approach, I always, keep it by hand for a while, just to see how the numbers are changing, to see how what the impact of the calculations are as they meet, numbers that may be outside of the norm. So I give you a classic example. If you use a 10 to 10 period moving average was very widely used because it was easy to calculate. You just added the 10 prior figures and canceled the last digit, and you had the 10 period average. So that was very, very popular. But a 10 period average, you're constantly dropping off a piece of data each day and adding a new piece of data on. And if the piece of data that you're dropping off is markedly different than the average, then the average is going to change regardless of whether price today changes. And so that's the sort of thing that you really don't learn unless you keep things by hand. So I don't think it's impossible to learn the craft now, but I think you have to try harder and you have to look a little deeper and read a little longer in order to get the sort of intimacy with the data and the process that we had back in the day when I started.
So I always go back to every strategy is a function of three things. One is the signal. So focus on obviously Bollinger Bands. Two is the look back period, which is what you alluded to, 10-week or whatever period you're looking back, 200-day moving average, whatever it be, right? But then the third thing, and I always emphasize this point that's equally, and maybe in some cases more important, is the opportunity set with which you express an idea based on what the signal is telling you. This year is a good example of that. People would say, well, this has been a risk-off period. I would argue no. Why? Because the opportunity set for risk-off treasuries has not acted risk-off, which means that any kind of indicators that I rely on really hasn't, it's not a function of whether it's worked or not. It's a function of the opportunity set treasuries not behaving the way it should, interacting with the signals. Talk through to the audience this point around indicators maybe working for some asset classes better than others, and what happens from your experience to investor psychology when you're in a period where whatever you've backtested just for a moment of time doesn't want to seem to work, how you kind of manage through that emotionally.
So the first bit about that is backtesting is fraught with peril. I mean, it's very, very hard to do well. There's so many traps, so many ways to fool yourself that and not produce a robust result that you really have to think about what you're doing. Most people just flip a few numbers into the machine, say, "How did I do?" And the machine says, "Well, you did great." And the guy said, and then they go, "Wow, let's go." It's got to be more than that. Even if you just do something as simple as take your back test period and break it into chunks and see if the results are similar for the different chunks. Almost anything that you do that adds some value will be very helpful. So that avoids a problem that a lot of people have, is that they create a system, test it, and all that, and then when they trade it, it either fails utterly or produces worse results than expected. As for approaches in different markets, there's no question that different sorts of markets behave in different ways. My favorite example in this regard is forex trading. So forex trading is a form of pairs trading. You're long one currency, short the other currency, and pairs trading has a really special statistical property in that pairs exhibit a statistical property called stationarity, and that makes them really super suitable for a sort of a mean regression sort of approach. But the problem with that is a lot of people fall into that, and then when they hit a period in which the pair that they're trading starts trending hard, they don't recognize that there's been a change in regime, and they keep executing the old plan, and that costs a lot of money. So you have to respect both the dynamics of the underlying thing that you're trading, whether it's a commodity or a stock or a forex pair. Or I happen to like. I think that these cryptocurrencies trade really well with technical approaches. So I think you hit on a really great point, and it's a point that requires some thought on the part of the practitioner. In my view, the problem is that, and this is really really true. I think problem is most people just don't think about this stuff. They don't sit there hard on the chair cushion and think about what they're doing. They just do. And, if you don't think about what you're doing, then you're heading for some pain.
So there's two directions I want to go with. I'm loving the way this is already shaping up here. So one is, I'm with you on this idea that backtesting is fraught with risks. And I think it's fraught with risks because people have the natural tendency to want to over optimize to find the perfect equity curve, right? That is a can't lose straight up and to the right. When arguably I would say that the best back tests are the ones that actually have drawdowns, that have periods where they are desynced, right? Because then you at least can say historically it's probably real. The other part about back tests, right? No, really, because and it's like if it's too good to be true, it probably is.
Yeah,
right?
yeah.
That's kind of the point. And that applies to trading too, right? But the other part of this is that some people will just be anti back testing, but they'll believe in buy and hold at the same time. But buy and hold is also a back test. It's just a back test with one trade, right? So I think that and I want to hear your thoughts on this. I think the key when it comes to looking at anything historically is go for simplicity, go for the thing that explains maybe 60, 70% of why a stock, why a market does what it does, and accept the truth that the rest is probably randomness. And go for simplicity because the more indicators you follow, the more errors there are, and that's where butterfly effects kick in. I want to hear your thoughts on that dynamic because I just think that when it comes to backtesting, people have it wrong.
I'm a huge fan of simple systems. I think that complex systems are almost always curve fit. I think it's just almost impossible to build a complex system without curve fitting. So I really believe in simple systems, and I have a very very strong preference for something which I call first principles. These are the operating principles of markets and such like that. As an example, I always get this question as to why Bollinger Bands haven't been arbitraged out of service. Basically, they're 40 some odd years old now. They're widely distributed. They're every piece of software everywhere. The laws of the universe say that this stuff should be arbitraged out, but they haven't. They work more or less the same way they worked 40 years ago. There have been some small changes to how they work, but they're really small changes. And the reason that they work, the reason that they continue to work is because they touch a first principle of the market. And that is, in this case, that first principle is volatility and the fact that volatility changes in cycles over time. Using volatility to define whether prices are high or low on a relative basis, again, which is what Bollinger Bands and all other trading bands do, then allows you to define high and low on a relative basis in a way that lets you build rigorous trading approaches with tools that will not be arbitraged out from underneath you.
I'll take it even a step further, though, because I would argue the reason any indicator that's based on some kind of anomaly works is because there are plenty of times where it doesn't. So in other words, I always go back to this point that if something is always right, if something's always hitting it out of the park, that's when it gets arbitraged away because everyone believes with such rigor this is the way to make money in a guaranteed way.
Hold that thought for a second. Before you said if you could explain 60 to 70% of price action with an indicator or system or approach, I think that's hugely optimistic.
Yeah, no, you're right.
In my world, if you can explain 30-40% of what's going on with an indicator, you've got a home run hitter, right? I mean, you've got something that's going to do you really well. Of course, it's not going to have a perfect track record. It's not going to be 100 out of 100 trades, blah blah blah. You're going to have, I don't know, 62, some odd percent of trades that are winners and the rest are losers. And, if you're good at what you're doing and you employ the appropriate disciplines, your losers are going to be much smaller than your winners and you're going to be in business.
No, that's 100% right. But going along the lines of sort of the idea that an indicator keeps working over time because it has periods where it doesn't work, every indicator has these false positives, right? Where it tells you to do something and the single roll of the die, it's not working. And what happens is that eventually you end up having a streak where it seems like the indicator is quote unquote broken, which causes people to then doubt the efficacy of the indicator, which is what makes the indicator work because you need doubts, you need the false signals, you need the times when it's wrong to prevent the discipline needed to actually arbitrage an anomaly away. Right. So it's like you always need to have those periods for any indicator to work. If it's always working, it will be arbitrage. It's the doubt that is needed from the false signals, which is so critical, I think, which goes back to the point about, the best back tests are the ones that have drawdowns.
I totally agree with that. But I would say that applies more to instead of just indicators. I would say that applies more and absolutely to systems that generate, discrete signals and such. Some indicators are, like state of the market sorts of things that give you background information and such. And I'm not sure that applies to that group of tools, but to the things that actually generate buy and sell signals, which are so popular, then I agree with you completely. I think initially, especially for the larger, well-known coins, is that they were clean markets. There were no futures, there were no options. They were just there was very very little in the way of arbitrage, if there was any at all. So you had pure markets. Something which we haven't known about in the West for the past 40 years, right? I remember the launch of the first stock index futures contract, the value line, based on the value line geometric by the Kansas City Board of Trade, and it's been downhill from there in terms of signal to noise. The noise has continually increased as the derivatives market around stocks has grown in volume. So I think initially it was that these were pure markets, and you could see the supply demand mechanisms at work in their purest and clearest state. So, but then, now we have futures, and there's arbitrage and all this stuff creeping in. So the signal to noise ratio is starting to deteriorate, and it's a little harder, but they still trade well. And part of that is because they are often traded as pairs, and pairs are always easier to trade, for me at least, than things that are, like an individual stock or a individual commodity, something like that.
I also think it's partially just because when you don't have something fundamentally you can anchor onto, you need to have something, right? So technicals are pretty much it. I mean, you see that old dynamic also with story stocks and companies that don't have much earnings. It's not really about anything except what is the trend? What are the oscillators saying? What are the indicators saying?
Well, the interesting thing is that technicals often forecast fundamentals. The classic example to use is Enron. Every technician in the world knew that Enron was dead meat, 6 months before Enron said it was. I think what I tell people to do in circumstances like this is to prepare a list of the things that they want to own, and, watch them like hawks, try to understand what's happening to them, try to understand, why they're being sold off and in the ways in which they're being sold off. And, when the time comes and they stop declining and build bases and start turning back up, then they'll know what to do. I think you're talking about you have to sell something, what to buy. Well, we constantly keep lists of candidates that we would like to own for one reason or another. And, if we sell something, we go to those lists and we look and we see, well, we sold ABC and XYZ is rotating into place here. Let's give XYZ a call. What you have to have is a rudder. I mean, that's the problem is that most investors are rudderless. They just get, washed around by what's happening in the markets. And, whatever the last impulse move is, the direction they think the compass is pointed. So if you have a rudder, for example, we like long-term growth from a portfolio perspective. That's, a core idea here. So we keep a list of long-term growth. And when things like that get marked down, we go and check and see if there have been changes or if the plan is still being executed as it's supposed to be executed. Then we get a green light to take a position. So, back when I started in at full time in the market, 1980, we had a trading system based on the Dow Jones Industrial Average. We used a 21-day moving average and 4.5% bands. So the moving average shifted up and shifted down by 4.5%. And we kept two indicators, one based on advances and declines and one based on up and down volume. They were simply 21 period accumulations of the net. So advances minus declines, a sum for 21 days, or up volume minus down volume, a running sum for 21 days. And the rules were quite simple. If you tagged the upper band and one of those indicators was negative, that was a sell alert. And if you tagged the lower band and one of those indicators was positive, that was a buy alert. And then you waited for the market to confirm. And if the market confirmed your opinion, then you actually had a signal and you took a position. That system worked really well for a really long time. So basically, I came to trading bands in conjunction with indicators. I never, when I started out, I didn't use trading bands solo. I always used them in conjunction with indicators. And I had a very, very strong preference for volume indicators. I like David Bastian's intraday intensity especially well. I think it's a great companion to trading bands. But you asked about ADX, which is an interesting choice because ADX isn't really a companion indicator to trading bands, but ADX can give you, it's what I call an environmental indicator, right? And it tells you what mode you should be operating in. So with low values of ADX, for those people that don't know, ADX is an indicator that's part of the directional movement complex that Wells Wilder wrote about in his book. And it's an indicator that focuses on whether the market is trending or not. Generally, values in ADX below 18 are considered to be non-trending markets, and values above 18, or I think it's 18, are considered to be trending markets. And more interestingly, rising values of ADX are indicative of trending markets, and falling values of ADX are indicative of non-trending markets. So that tells you what sort of regime you want to operate in with your trading bands. So in non-trending markets, you want to focus on mean reversion sorts of strategies, and in trending markets, you want to focus on trending strategies. Trading bands can deliver both of those to you. The idiocy of that surrounds trading bands is this. People think that a tag of the upper band is simply a sell signal and tag of the lower band is simply a buy signal. Well, you show me a set of trading bands that produces that with a 60 or 65% success rate, and I will show you the keys to the kingdom. The fact is that all trading bands do is answer the question as to whether prices are high or low on a relative basis. It's up to you to take that information and combine it with indicators and other approaches to make rational investment decisions. The misapplication is simply taking a tag of the upper band by price as a sell signal, or taking a tag of the lower band by price as a buy signal. That's a classic misapplication. Can they be buy signals or sell signals? Absolutely, but you need to bring more to the table. Even if it's something as simple as a confirmation technique by price, you need an up day to trigger a buy signal, or you need a down day to trigger a sell signal. The question is, it's a really interesting question about the efficacy of trading bands, my bands, or any other bands in different types of markets. It's not so much that the bands work better or worse in different sorts of markets. It's that price behaves differently in relation to bands in different types of markets. There are some, but there are very few applications of trading bands that I know of that are monotonic, that will just remain the same through all market regimes. As I say, there are a couple, but they're rare birds. More likely, you can focus on, if the market's not trending, deploying non-trending systems, mean reversion systems. And if the market's trending, then you would focus on employing approaches that take advantage of that. For example, one of the classic approaches of Bollinger Bands is if price gets into the upper range of the upper band, say within 10% of the upper band, and an up down indicator like the money flow index, which is basically a supply demand indicator, is strong. If you're in a trending market, then that is in fact a strong buy signal. But if you're in a non-trending market, it may work, but the odds of success are not going to be with you. Let's start with one of the oldest market maxims. The most bullish thing a market can do is get overbought and stay so. So the most bearish thing a market can do, conversely, is get oversold and stay so. I mean, these are simple market dynamics. People have known about these dynamics. This stuff was written about back in the 20s and 30s by people like Richard D. Wyckoff. So there's nothing new under the sun in that regard. So if you're bearish here, which is the other part of the question, then expect a walk down the lower Bollinger Band and start looking at indicators like money flow, MFI index, and look for non-confirmations by money flow to suggest places where you might want to think about the trend ending. But as long as money flow keeps on confirming the walk down the lower band, then you're going to be walking down the lower band. That's why the great sin of trading bands is taking a tag of the upper band as a sell, and the tag of the lower band as a buy. Price can and does walk up the upper band for long periods of time and down the lower band for long periods of time. It's just what happens with bands, and bands. That doesn't mean that bands are broken. In that mode, bands are working in a trending mode.
Are Bollinger Bands suitable more for longer term investing or for shorter term type of day trading? So talk about time frame when it comes to indicators, because I think that's important. It kind of goes back to the question of what's your look back period.
So I tend to leave the look back period, the numerical value of the look back period, the same. What I change is the amount of data in the bars. So very short-term traders may, want to use something as, very short-term bars with just a few minutes of data in them, or even shorter. I tend to use primarily daily and weekly bars Although I often look at monthly bars as well, because I came from a time when trading expenses were really high. We called ourselves swing traders back then because we went for the big swings in stocks, the 10, 20, 30, 40% swings in stocks, because trading expenses were extraordinary. So, short-term trading simply wasn't possible except for pros who were broker dealers. It just wasn't part of the puzzle. So, I'm a longer term swing trader, but I tend to stay with, for example, the defaults for Bollinger Bands are a 20 period uh, moving average and plus or minus 2 standard deviations. I tend to stay with those defaults and change the bar lengths instead. Some people like to play around with the length of the look back period. And I found that the practical limits seem to be between 10 periods and 50 periods. If you get out toward 50 periods, if you feel your approach needs, bands with a look back period that long, then I think you really ought to shift your time frame in terms of your bars up to a higher time frame. If you're looking at hourlies, go to dailies. If you're looking dailies, go to weeklies and go back to 20 periods. It has to do with the calculation of standard deviation. Somehow, when you get, up to higher calculation lengths, the bands behave a little differently. 20 periods seems to be about the optimum calculation period for the sorts of work that we do.
I will say also that 20 period is probably not a coincidence, because that happens to be 20 trading days, which is a month. And there's all kinds of studies that show month over month momentum is a very real thing.
Yeah. In the old days, they said it was, the number of trading days in a lunar cycle. There's a lot of explanations for it. And the amazing thing is 20 has remained as robust as it has over the decades. So it's tuned into some first principle of the markets. Of that, I'm pretty sure. The interesting thing, I'm a CFA, but I'm also a CMT. In fact, I'm the first joint designation holder, simply by the fact that I was the only CFA that took the first CMT exam. I guess I really like the sorts of knowledge that I studied and learned in the CFA program, and I found it very, very helpful to me over the years. Harry Markowitz had some remarkable insights into portfolio construction. So the question you're asking about is, technical in general, to genericize it, is, in building a technical portfolio, do you want to trade a single system with a single vehicle, or do you want to trade that system on, say, 5 or 6 or 7 relatively non-correlated items? I think what you're going to find is that as you head toward that diversification, your equity line is going to smooth out pretty dramatically. And you're going to be much, much more comfortable executing the system, especially at the times that, like Michael points out, when the system falls out of favor. If you have a smoother equity line and you have some more diversification, I think it'll be easier to weather those hard times. Well, I think Fed policy, just like Fed policy for stocks, Fed policy for crypto is going to be important. You dry up liquidity, crypto is going to have harder going. You provide a lot of liquidity, and crypto is going to have easier going. So I think that the old Marty Zweig idea of don't fight the Fed applies to crypto as well as to stocks. When I started trading crypto, it was really non-correlated to stocks. I mean, the correlations for the top coins that I was looking at, Bitcoin, Ether, Litecoin, such like that, were all in very low values to the stock market. So that's changed, along with things like the grayscale funds and such like that, and then subsequently all of these funds that offer exposure to Bitcoin futures and such like that. that's all of that stuff has really increased the linkage, and crypto has become much more a risk on, risk off asset than it was. And I think that trend will continue. I think it will continue to get harder to trade crypto than it was in the past. Still be easier than trading stocks and stock index futures and such like that, at least for the foreseeable future. The first 10 years of the ETFs, I remember the ETFs were preceded by primes and scores on the American Stock Exchange. There was, and ETFs, the success of primes and scores, especially from a regulatory point of view, because they hammered out the regulations for that sort of thing in that era, led the way to ETFs, and all of that stuff was really exciting and offered tremendous opportunities. We used to try to trade the Fidelity sector funds, and they come around with a baseball bat and smack you whenever you traded too much, and it was just really unpleasant, and you understand. But the problem is that ETFs have acted to weld the market together. Now that they become so popular, people don't understand that when you buy SPY, you're generating a little buying in each of the stocks in SPY, and when you buy SH, you're generating a little of this little selling in the stocks that are in the S&P 500, and that selling is evenly spread out across all those stocks. So it has the effect of welding the market together so that the independence of individual stocks is much less than it used to be. And that's really a shame. Because diversification used to be way easier to achieve than it is these days.
Oh, I love that you said that, because I've used that line in an unfiltered way that, one of the things that few people understand is that it's all one big fucking leverage trade, because everything's co-moving the same way and often driven by the same factors, which is beta, liquidity, so on and so forth. So diversification largely becomes an illusion, which we can save for a different conversation.
On Thursday morning at the CMT symposium, I'm going to give an hour talk on first principles, and I'm going to go back through history and touch on 12 technicians who uncovered first principles, and what those first principles were. We'll just talk about one here as sort of a teaser. And it's going to be streamed, so everybody can get access to it. But there was a technician, which most people have forgotten now, by the name of Garfield Drew. He was very active in the 30s, 40s, and into the 50s. He's known today primarily for his book, New Methods. But at the time, he ran a service called the Odd Lot Service. And he tracked the actions of odd lot investors, people who traded 1, 2, 5, 10 shares of a stock rather than a round lot of 100 shares. And these tended to be small retail investors, and it was thought about to be naive or uninformed money. And when there was a ton of odd lot buying, it was the top of the market. When there was a ton of odd lot selling, it was the bottom of the market, so on and so forth. And the interesting thing is that for 40 years, these indicators, this odd lot, a complex of indicators, worked fantastic and delivered tons of alpha. And then, in the very early 70s, it was like somebody flipped a switch and it just stopped working. Now, it wasn't that retail investors got any smarter, or the odd lotters, uninformed money, all of a sudden had access to very high levels of counsel or anything like that. It was a structural change in the markets, and that put an end to the efficacy of the odd lot statistics. But for a period of 40 years in which everybody knew about it, the odd lot numbers delivered alpha in spades. So there's tons of first principles in the market. The first principle in this regard was uninformed money, or such like that.
Now, very good. And listen, for everybody that's here, again, please make sure you follow John Bollinger. Check out his website, his research, obviously. as you can tell, really one of the greats in the industry in the way that he thinks about things, and obviously in the contributions he's provided to the field of technical analysis. John, first time you and I speak, I appreciate the flexibility, you joining, being a part of this, and thank you again for imparting your knowledge here to the group.
Entirely my pleasure. Thanks for having me on.
Thank you, everybody.